If you buy into an AI ETF right now, you'd naturally assume Nvidia is sitting right at the absolute top of the portfolio.
Oh, absolutely. I mean, they're the poster child of this whole compute revolution.
Exactly. The trillion-dollar behemoth dominating every headline. But in one of the highest performing thematic funds on the market today, the biggest AI company in the world isn't even in the top spot.
Which is pretty wild to think about, honestly.
Right, because they're prioritizing the foundational infrastructure over the headline act. They're betting on like the concrete and rebar of the data center rather than just the processors themselves.
Yeah, the real underlying picks and shovels.
Exactly. So welcome to the Time and Market Deep Dive. Reminder, this is just for entertainment purposes. Seek professional advice. We actually have a viewer request to discuss today.
I always love when we get these specific requests.
Same. So today we are looking at the VistaShares Artificial Intelligence Supercycle ETF, ticker symbol AIS.
Nice. It's a really fascinating one to dig into.
Yeah, so our mission today is to look under the hood of AIS, break down their bill of materials methodology, and analyze their current price, performance, and key multiples. And then we'll compare it against the broader AI ETF landscape.
Sounds good. And, just to set the stage here, we should probably talk about why thematic ETFs are surging so much right now.
Right, because it's a massive trend.
It really is. And it's because trying to pick one single chip maker or software startup right now is, well, it's taking on a massive amount of single stock blow-up risk.
Yeah, if you bet on the wrong horse, you're wiped out.
Exactly. But forecasts are suggesting this entire sector could grow something like 300 times its current size by 2032.
Wow. 300 times.
Yeah, it's staggering. So thematic ETFs smooth out that volatility. They let you stay exposed to that super cycle without having to perfectly time the market on just one company.
That makes a lot of sense. But to understand why a fund like AIS even exists, we have to look at the structural flaw in traditional index investing, right? Like the standard GICS sectors, the Global Industry Classification Standard, they are just totally breaking down in the AI era.
Oh, completely breaking down. GICS was designed for this older, heavily siloed economy.
Right, sorting everything into 11 rigid sectors.
Exactly. Which works fine if you're trying to categorize, a regional bank versus a grocery chain. But it fails entirely when a paradigm shift like AI bleeds across physical and digital boundaries.
Yeah, the sources gave this perfect example of Siemens Energy.
Mhm.
Under the traditional framework, Siemens is just walled off into industrials.
Right, they're an industrial company on paper.
But if you buy a pure technology ETF expecting to capture the whole AI build-out, you completely miss Siemens. Yet they provide these massive gas turbines, the grid-level transformers.
All the literal physical power needed to run a gigawatt-scale data center.
Exactly. Without that industrial-scale power, the tech sector's AI ambitions just grind to a halt.
And that disconnect is exactly what the VistaShares team saw. It's the foundational premise behind their bill of materials approach. They basically abandoned those rigid legacy labels to look at the actual physical supply chain.
Yeah, they treat the AI build-out like a giant construction project. It reminds me of like baking a cake. You can't just invest in the finished cake, the consumer AI apps. You have to invest in the flour, the sugar, the oven itself.
The oven itself is a great analogy. They target the absolute base layer. To even get into the AIS fund, a company has to pass this really strict purity filter.
Right, the 50% rule.
Exactly. They must derive at least 50% of their revenue or devote 50% of their assets to high-performance semiconductors, AI data centers, which includes power and cooling, or AI-enabled apps.
So that 50% threshold strips out the big conglomerates where AI is just a buzzword on an earnings call, right?
Exactly. If it's just a fun side project that makes up 2% of their revenue, they aren't getting in.
But let me push back on that a bit. If this is just some rigid algorithm scanning quarterly reports for a 50% threshold, couldn't it get trapped holding obsolete hardware companies? I mean, product cycles in this space move in months, not years.
That is a very real risk, but VistaShares isn't doing this completely passively. AIS is actively managed.
Oh, really? So they have human oversight.
Yeah, they use an active risk management overlay. The index sets the baseline, but the investment committee is constantly monitoring for bottlenecks. If a company loses its edge between the semi-annual rebalancing dates, they can step in and adjust.
That's a huge distinction.
It is. They even have the flexibility to allocate 20% of the fund to emerging AI companies that maybe don't hit that 50% revenue mark yet, or they can just pull that 20% into cash if the sector gets too hot.
That flexibility makes a lot of sense, especially when you look at how the fund is actually allocated.
Yeah.
So as of late, May 2026, they've got roughly $697 million in assets.
A solid chunk of change.
Definitely. And it's roughly 89% in technology, but they have that crucial 10 to 11% allocated to industrials.
Right, capturing that physical build-out we talked about.
Exactly.
Yeah.
And geographically, it's about 60% US, 15 to 16% Taiwan, with the rest in China and South Korea.
Which perfectly mirrors reality, right? You just cannot make advanced memory or logic chips without Taiwan and South Korea.
You really can't. But this brings us to the biggest surprise, the one we teased at the start. Nvidia is not the top holding.
Still crazy to hear.
I know. The top spots are actually SK Hynix at 12.18%, Micron Technology at 8.08%, AMD's at 4.72%, Silicon Motion at 3.87%, and Vertev at 3.76%.
Yeah, and that specific weighting tells you exactly where the fund managers think the real leverage is.
Because everyone else is just staring at GPUs.
Right. But the fundamental constraint on AI right now isn't just processing power, it's the von Neumann bottleneck.
Okay, unpack that for the listeners. What is that?
So you can have the fastest processor on Earth, but if you can't feed it data fast enough, it just sits there idle. The actual physical choke point of modern AI is memory bandwidth.
Ah, which explains the massive concentration in SK Hynix and Micron.
Exactly. They dominate the high bandwidth memory market, or HBM. They vertically stack memory chips right next to the GPU to solve that bottleneck.
So AIS is betting that advanced memory captures a huge chunk of the profit pool because the whole system breaks without it.
Yep. And then look at Vertiv in the fifth spot. That highlights the second physical constraint, thermal management.
Right, cooling. Because these new chips draw insane amounts of power.
Hundreds, sometimes thousands of watts per chip. Traditional data center air conditioning cannot handle it. The literal silicon will melt.
Wow.
Yeah, so Vertiv provides critical liquid cooling infrastructure. AIS is just doing a targeted strike on the physical limits of the industry. Memory to feed the chips, cooling to keep them from melting.
Okay, that strategic focus makes sense, but what about the fundamental financial risk? Building fabrication plants or liquid cooling systems requires astronomical capital expenditures.
Oh, it's massive. Billions of dollars.
Right. So because of that heavy capex, their profitability can swing wildly. Missing one product cycle could just wreck their margins.
And the sources tackle that cyclicality head on. The hardware business is brutally capital intensive, but that's exactly why the bill of materials diversification strategy is used.
Because you aren't just betting on one server contract.
Exactly. You are making a macro bet that the total demand for compute, memory, and thermal management will keep going up, regardless of whose logo is on the final server rack.
But that macro bet does not come cheap. Let's look at the valuation. As of late May 2026, AIS is trading around 76.65 to 76.79.
Okay.
And the PE ratio, the price to earnings, is sitting at 50.74.
Yeah, that's a big number.
To a traditional value investor, a 50 PE on cyclical hardware companies sounds like a textbook bubble. I mean, are we in a bubble here?
Well, AI is actually forcing Wall Street to completely rethink traditional valuation models. The AI inflection paper we reviewed gets right into this. It argues AI is causing a renaissance in how we view value versus growth.
How so?
So think about a discounted cash flow framework. A company's intrinsic value relies really heavily on its terminal value, the idea that it'll keep generating stable cash flows forever.
Right, the long-term safety assumption.
But AI is actively destroying the terminal value of legacy software and quote-unquote quality stocks.
Because an AI coding agent can just replicate a software company's core product for a fraction of the cost.
Exactly. So a safe value stock trading at a 15 PE might actually be a value trap because its future earnings are facing an existential threat from automation.
Wow. Okay, so the market is flipping the premium. Investors see the hundreds of billions being spent on data centers and realize that physical infrastructure companies have way clearer near-term earnings visibility.
Right. You can automate code in seconds, but you cannot automate a liquid cooling manifold or a semiconductor fab plant. Those take years to physically build.
So they have physical moats. And that's why investors are willing to pay a premium 50 multiple for AIs.
Exactly. The physical bottlenecks protect their moats.
And honestly, the performance data completely backs up that infrastructure thesis. I mean, in 2025, it ranked in the top 1% of its Morningstar category.
That's incredible.
And the momentum just kept going. Year to date in 2026, it's up roughly 58%. And if you look at the trailing one-year data, it's up over 176 to 179%.
Those are just crazy numbers, but we have to put that into context. A return approaching 180% in a year reflects a generational reallocation of capital.
Yeah, the whole market just woke up to the physical constraints and repriced the entire supply chain.
Exactly. And it's not just institutional money. The retail sentiment is shifting too.
Oh yeah, the Reddit trend. That was fascinating.
Right. Retail investors are literally liquidating their individual tech and energy stocks to go all in on this synthetic infrastructure portfolio.
Pairing the AIS ETF for compute with the POW ETF for electrification.
Yeah, they're outsourcing the complex supply chain navigation to VistaShare's active managers because the landscape is just shifting too fast.
Which makes sense. But, we should compare AIs to some of its competitors because they aren't the only game in town.
For sure. There are some massive passive vehicles out there.
Like AIQ from Global X. They're the behemoth, sitting on $8.6 billion in AUM.
But AIQ is heavily tracking the tech giants, right?
Yeah, mostly software and cloud providers, not the granular physical supply chain. Then you have funds like BOTZ and Robo, which are focused on physical robotics and automation.
But you have to be careful there. The historical data on Robo is a great warning. They operate in this highly disruptive robotics space, but Robo has actually underperformed the S&P 500 historically.
Ouch. Yeah, that really proves that just picking a cool high-growth theme doesn't guarantee market-beating returns.
The specific company selection and valuations still matter.
Definitely. And then there's ROBT, which is very software-heavy and tilts towards mid-cap. So if you think cybersecurity and software will outpace the physical infrastructure, that's your fund.
But no matter which one you pick, you have to look at the fees and the volatility.
Oh, for sure.
The Aquila study on 50 AI ETFs brought some much-needed reality to this. AIS charges a 0.75% expense ratio.
Which is pretty high.
It is. The average across all those AI ETFs was 0.61%. And if you just buy the S&P 500 through SPY, it's only 0.09%.
So you're paying a massive premium for that active bill of materials management.
Exactly. And the volatility is the other catch. The study showed AI ETFs have an annualized risk, or volatility, of 22.67%.
Compared to just 16.51 for the S&P 500.
Right. So a 22% annualized risk means the drawdowns during a market correction are going to be vicious.
Because they're so hyper-concentrated in hardware and CapEx cycles?
Exactly. Any hint that the big tech companies are pulling back their spending, and funds like AIS will see massive, rapid sell-offs.
So bringing it all together, what is the final verdict here? Does AIS justify that 50 PE and the higher fee?
Well, obviously we can't give financial advice, but the data paints a pretty clear binary picture.
Okay, lay it out.
If you believe AI scales physically, meaning it requires this massive, unavoidable increase in power, memory, and cooling, then AIS's infrastructure focus absolutely justifies the premium valuation and the fee.
Because they own the actual bottlenecks.
Exactly. But conversely, if you fear a pullback in capital expenditures, that 22% annualized volatility means you should probably proceed with caution or just stick to a broad market fund like SPY.
Because if you can't stomach a 30% sector rotation, you'll just end up selling at the bottom anyway.
Exactly. You have to know your risk tolerance.
So for the listener trying to prep their portfolio strategy, the big takeaway is that understanding how an ETF picks its stocks like this bill of materials approach is just as important as the overarching theme itself.
It's all about owning the foundation of the house, not just the smart home gadgets inside it.
Perfectly said.
And it leaves us with a really profound philosophical question to think about.
Oh, what's that?
Well, we just spent this whole time analyzing how AI is forcing Wall Street to rewrite the traditional definitions of value and growth because it can automate so much cognitive work, right?
Yeah, destroying the terminal value of software.
So the question is, how long will it be until AI, integrated with advanced robotics, forces us to rewrite the definition of human labor and value in the real physical world?
Oh, wow. That is a heavy thought. The physical infrastructure they're building right now is essentially the prerequisite for finding that out.
The concrete is still drying.
It really is. Well, something to chew on for sure. Thanks for joining us on this deep dive.